see that now? Okay, so welcome to the second webinar that we've been running on behalf of the Suffolk Chamber of Commerce and Essex Chamber of Commerce. My name's Paula Mason. I'm the VAT manager at Scrutton Bland, and I'm happy to take you through the slides today. As Chris said, we're going to go through the slide pack. If you have any questions, please put them to us. And at the end of the slide pack, we will be doing a 22 question quiz. So hopefully you'll be able to keep up with the slide pack, and all the answers to the quiz questions will be in the slides. Okay, so just to recap, some of you may not have attended the first webinar, so I thought it was a good idea just to go through a few things to recap general principles of VAT and the place of supply for goods. So VAT, obviously, there's various types of supply. Taxable supplies, which is any supply which is not exempt from VAT, and they fall into three categories. Standard rated at 20%. Some examples of these are new cars, business use fuel or power, a new build of commercial building, or an opted to tax commercial building which is more than 3 years old. Then we have reduced rate VAT, 5%. Some examples of this are domestic or charity non-business use fuel and power, building materials used in empty residential / charitable use buildings. And then we also have zero rate supplies, which are taxable supplies, but at a zero rate of percent. Some examples of those are books, new houses, export of goods, sale of non-residential building converted to residential use. So the other types of supplies are exempt supplies. So that is any supply where no VAT is applicable. And an example is a resale of a residential dwelling. And then also outside the scope of UK VAT supplies, these are supplies which are outside the VAT system and therefore VAT doesn't apply. And examples of these are goods supplied outside the UK, or goods installed or assembled outside the UK. So going on to VAT thresholds, we did mention this in the first webinar. So compulsory registration applies to where a business has total taxable turnover for the last 12 months of £90,000, or taxable turnover is expected to exceed £90,000 in the next 30 days. If your taxable turnover is less than 90,000, you can register voluntary. If you only make tax exempt supplies, you cannot register for VAT. And taxable turnover equals your total value of taxable supplies, not including VAT exempt or outside the scope supplies. And it's calculated on a rolling 12-month basis. Just one thing to add there, if any of you are familiar with reverse charges, they would come under your taxable turnover. We have seen in the past quite a lot of occasions that people don't realise that services subject to reverse charge should be included in the taxable turnover calculation. For businesses located outside the UK making taxable supplies to the UK, there is a nil VAT threshold, and they are known as non-established taxable persons. So just to go through some VAT terminology again, so output tax is VAT charged on sales, input tax is VAT suffered on purchases, VAT payable or repayable is your output tax less your input tax. So a fully taxable business only makes taxable supplies, which can be standard, reduced or zero rated. An exempt business only makes exempt supplies. And a partially exempt business is one that makes a mixture of both taxable and exempt supplies. A repayment trader is where their input tax is normally higher than their output tax and therefore receives repayments of VAT from HMRC. VAT fraction is used to calculate the VAT from a VAT inclusive price. So the fraction for standard rated items is 20 divided by 120 or 1/6. And for reduced rated items is 5 divided by 105 or 1 divided by 21. And a VAT group is where two or more eligible persons can be treated as a single taxable person for VAT purposes, and therefore they only make one VAT return on behalf of the whole group. The standard VAT return period is 3 months, ending on the last days of either Group 1, Group 2 or Group 3, which are June, September, December and March, July, October, January and April, or August, November, February and May. The group is allocated upon registration by HMRC, but can be changed to align with your accounting year end. Monthly tax periods can be requested, and this is very usual in the case for repayment traders to improve their cash flow. The deadline for submission of the VAT return for any period, whether it's quarterly or monthly, is 1 month and 7 days after the tax period end. We also have some accounting schemes for VAT. One is the annual accounting scheme, and that applies to businesses with a turnover of 1.35 million or less. And within that scheme, they make monthly, quarterly payments on account with one VAT return covering the final payment. The flat rate scheme is for businesses with turnover of 150,000 or less, and various rates are charged. Flat rates are charged according to the business type. Penalties are charged by HMRC for both late submission and late payment. The VAT return itself consists of 9 boxes. So just quickly going through them. Box 1 applies to the output tax, VAT due in the period on sales and other outputs. Box 2 is VAT due in the period on acquisition of goods into Northern Ireland from EU member states. We'll go through that slightly later in the slide pack. Box 3 is your total VAT due, which is box 1 plus box 2. Box 4 is your VAT reclaimed in the period on purchases and other inputs, including acquisitions of goods into Northern Ireland from the EU member states. Box 5 is a net VAT payable or repayable to or from HMRC. Box 6 is your total value of all your sales, excluding VAT. And box 7 is your total value of all your purchases and other inputs, excluding VAT. And box 8 and box 9 both apply to Northern Ireland. That's the total value of all your supplies, excluding VAT from Northern Ireland to EU member states, and total value of all acquisitions of goods and related costs, excluding VAT of goods into Northern Ireland from the EU. So when does the UK VAT apply in relation to goods? So it applies to business transactions where the place of supply is the UK, it's made by a taxable person in the course of business. A taxable person is a business who makes taxable supplies and is required to be VAT registered. Place of supply of goods. For UK VAT to apply, a supply must be made in the UK. Supplies made outside the UK are outside the scope of UK VAT. So if the goods are in the UK when they're supplied, the place of supply is the UK. And if they're outside the UK when they're supplied, they're outside the UK. If they're installed or assembled outside the UK, the place of supply is outside the UK. And goods supplied from Northern Ireland to the EU under the distance selling rules, which are less than the threshold, place of supply would be the UK. And if over the threshold, it would be the EU member state where delivered. So when it comes to exporting goods outside the UK, there can be 2 types. They're direct exports, and this is when the supplier sends goods to the destination outside the UK, and they could be indirect, and that's when the overseas person or their agent collects goods from the supplier in the UK and takes these goods outside of the UK. The time of supply is the earlier of the date the goods were sent or collected and the date full payment received. For direct exports, the supply is 0 rated if they are exported within specific time limits, official or commercial evidence of export is obtained, and also supplementary evidence of the export is retained. For indirect exports, the supply is 0 rated if the overseas customer or their agent exports the goods within the set time limits, obtains and gives the supplier evidence of export within set time limits, and supplementary evidence of the export is retained by the supplier. If in doubt, the supplier should keep a deposit equal to the VAT and refund it once evidence has been provided. And the time limits that we're referring to there for direct and indirect exports is it has to be exported within 3 months and the evidence should be provided within the same period. If the goods are involved in processing prior to the export, then those time limits are increased to 6 months. If all of the conditions are not met, the suppliers cannot be zero rated as an export, and that must be accounted for at the relevant UK rate. So what we mean by official evidence is the cleared export entry declared to HMRC. Commercial evidence refers to the physical movement of the goods, description of it. So examples of this would be an authenticated sea or air way bills of lading. And supplementary evidence would be the customer's order, consignment note, copy of export sales invoice, etc. Exports of goods from Northern Ireland to countries outside the EU, the same rules apply. But before exporting, an IORI number needs to be obtained. If goods are exported temporarily, then no sale has taken place, and therefore no input VAT has to be paid when the goods are returned. So examples of this are goods exported for a trade show or being returned after being sold on a sale or return basis. And the export of goods from Northern Ireland to countries outside the UK and the EU follow the same rules as for the UK. Now we're going on to movement of goods between Northern Ireland and the EU. So under post-Brexit protocol, Northern Ireland aligns with the EU VAT law in relation to movement of goods between Northern Ireland and the EU. So this is the same as what applied to the UK before we left the EU. So when we come to describing movements of goods between Northern Ireland and the EU, we refer to the supply of a good as a dispatch and the purchase of a good as an acquisition. And the tax point is the earlier of the 15th day of the month following the month when the goods are sent, or the date of the VAT invoice for the supply. So looking at business to business supplies, dispatches, the dispatch is zero rated and the place of supply is where the recipient is located. So therefore the recipient accounts for the acquisition in their own country. So we have an example here, goods totaling 50,000 dispatched from Northern Ireland to France. Northern Ireland business zero rates a dispatch, but it reports it in box 6 and box 8 of the VAT return. And the French business accounts for acquisition in their VAT return. In relation to business to consumer supplies, the dispatch is liable to UK VAT. The place of supply is where the supplier is located and it's accounted for on the VAT return like any UK supplier, so box 1 and box 6. However, if the supplies in a calendar year exceed €10,000, the supplier is liable to register and account for VAT in all EU member states where the supplies are made. And this threshold, which is known as a distance selling threshold, applies to all supplies made to customers throughout the EU. So it's a pan-European threshold. So if a supplier, or the Northern Ireland supplier, does exceed the threshold and needs to register VAT in the EU member states, rather than registering for in each member state, they can take advantage of using what we call the one-stop shop union scheme. This avoids them having to register in every single member state that they supply to. One quarterly return is submitted and one payment made for all supplies made, which are then distributed by the collecting country to all the other various member states. The Northern Ireland business can voluntarily register even if they're below the distance selling threshold. And it also includes distance sales of imported goods and B2C services. Going on to business acquisitions, the place of supply for acquisition is where the recipient is located. So if the acquisition is in Northern Ireland, UK VAT applies at the normal rate. So if it's zero rated in the UK, no tax would be due on the acquisition. The Northern Ireland business needs to include in box 2 and box 4, as well as box 7 and box 9 of their VAT return. So it's treated similar to a reverse charge in that they're accounting for the output tax as well as the input tax. Other reporting requirements need to be done. So we have the EC sales list. So all Northern Ireland businesses supplying goods to the EU, subject to acquisition tax, must submit these returns. The information is used amongst all the various member states to ensure that VAT has been correctly accounted for. They are submitted online either monthly, quarterly, or annually, depending on total sales. They also have to do intrastat declarations if they are over the annual thresholds, and that's for £500,000 for acquisitions and £250,000 for dispatches. And both intrastat and EC sales lists are submitted online on a monthly basis by the 21st day of the following month. So we come to the Windsor framework, which was set up in order to ensure that simplified arrangements could take place. The key aspects of the framework is the customs process, which is a 2-lane system. So we have a green lane. So for goods staying within the UK customs territory, simplified customs processes take place, including reduced paperwork and fewer checks. But for goods going to the EU, they have to go through the red lane, whereby they undergo standard custom procedures. Businesses can apply under the UK Internal Market Scheme for authorisation to move goods through the green lane. There's also a retail movement scheme, which allows movement of goods for retail sale in Northern Ireland and for medicines to be licensed on a UK-wide basis. And the Stormont break is where members of the Northern Ireland Assembly can prevent changes to EU laws that would have a significant impact on Northern Ireland. Now we turn to import of goods into the UK. So goods that are imported into the UK are subject to import VAT. Import VAT's normally charged at the same rate as if they've been supplied in the UK. But there are some exceptions to this, and an example which is imported works of art, which is entitled to be charged at the reduced rate. Import tax can be accounted for in 2 ways. It can be paid on importation, and a business would need an import VAT statement, which is known as a C79, as evidence of this in order to be able to reclaim the input tax on their VAT return. And we also have recently introduced a postponed VAT accounting scheme, which is similar to the reverse charge. It's whereby import VAT is accounted for and reclaimed as import tax on the same VAT return. So the VAT number must be included on your import declaration. And as a result of this scheme, if a business is fully taxable, there is a nil net effect in the VAT return. If a business is not registered for VAT, import VAT must be paid, but obviously cannot be reclaimed. Now we're looking at triangulation. This is a term used to describe a cross-border B2B sale of goods involving 3 parties in different EU member states. So we have an example here whereby we have business B in France receiving an order for some goods from business C in Spain. The goods are purchased by the French business from business A in Italy, but sent directly from business A in Italy to the customer in Spain. So by taking advantage of the triangulation simplified system, these would be the actions that would need to be taken. So in business A, it would be a zero rated supply, a dispatch to business B, and the invoice to business B includes business B's VAT number. Business A would report the supply in his VAT return, in the EC sales list return as an intra-community supply, and in intrastat return if the threshold's been exceeded. For business B, they would have a purchase from business A, and so we treat that as an acquisition. The supply to business C is a zero rated triangular supply. So the invoice to business C includes business C's VAT number and states that reverse charge applies in the country of business C. Business B reports the supply in the EC sales list return as a triangular supply, and some EU member states require both the purchase and supply to be reported in the VAT return, but not all, and it's not reported in the intrastat return. For business C, the purchase is reported as a reverse charge acquisition, so it's reported as both an output and input in their VAT return. Net VAT will be nil unless business C is a partially exempt trader, and the acquisition is reported in the intrastat return. With Brexit taking place, as the UK is no longer in the EU, triangulation no longer applies. However, they can still take advantage of the triangulation simplifications in the UK. So based on the above example, if business B is in the UK, the options for the UK company are that they register for VAT where goods are being shipped from, so Italy, and that would result in a domestic purchase in Italy and an intra-community dispatch to business C in Spain. Or they could register for VAT where the goods are being shipped to Spain. This would result in an acquisition and a domestic sale in Spain. Or they could register in another EU member state where it has no purchases or sales, and this would result in both an acquisition and a dispatch with a nil VAT position. So that's the end of the slide presentation. I know I've gone through that quite quickly, but there was quite a lot to get through. So now we're going to go on to the quiz. So if you can just bear with us for 5 seconds. Okay, so if everyone would like to join using the QR code on the screen, we'll just give you a couple of minutes for you to join. Okay, so I can see that some people are answering the questions already. That's good. Has everyone finished? I'm not sure if everyone's joined. I think everyone's now finished the answer to that one. So is the supply of a new residential dwelling a taxable supply, and if so, at what rate? Well, I'm afraid there's only one person that got that right, and it is a taxable supply, but at 0 rate. Right. Second question, is the sale of an existing residential dwelling a taxable supply, and if so, at what rate? Well done, everyone. I think everyone got that correct. It's not a taxable supply, it is an exempt supply. I think we'd all hate to have to pay VAT if we were buying a house. Third question, what is the current VAT registration threshold in the UK? Okay, most people got that correct. It is £90,000, 85,000, which I think two people said it was the last VAT threshold. What is the VAT registration threshold for non-UK businesses making taxable supplies to the UK? Well done, everyone. I think most people got that correct. So it is actually nil. Next one, what is the VAT fraction for standard rated supplies? Okay, so few wrong answers here. So it's either 100 over 120 or 1/6, same as. What is the deadline for submission of a UK VAT return? Yeah, most people got this one correct. Is 1 month and 7 days after the end of any tax period, whether it's monthly or quarterly. Next one, who usually requests monthly VAT returns? Yep, everybody was right there. So obviously must be VAT registered. But you would usually be a repayment trader in order to aid your cash flow. Okay, so what is the place of supply for goods valued at £25,000 supplied from Northern Ireland to a French individual? Right, okay, so not many people got this one correct. It would be France, because it's over the distance selling threshold. Next one. UK supplier sends goods to a non-UK customer. Is this a direct or indirect export? Okay, most people got that right. It's a direct export. If a direct export of goods is sent within the set time limits, is it a taxable supply for VAT purposes? And if so, at what rate? Okay, not many people got that correct, actually. It is a taxable supply for VAT purposes, but it's at a zero rate. What is the time limit for zero rating direct and indirect exports of goods? Okay, I think somebody got confused there with the deadline for sending in a VAT return because they've said 1 month and 7 days, but it's actually 3 months. Everyone else got that correct, so well done. So a UK business sells goods to a non-UK customer on a sell or return basis. Does import VAT have to be paid if the goods are returned? Well, I've done everyone. Everyone got that right. Yeah, no VAT would input VAT would have to be paid as temporary export. Next one, a Northern Ireland supplier exports goods to the USA within the set time limits. Is this a taxable supply, and if so, at what rate? Well done, everyone. Yep, that is a taxable supply at 0 rated. What term is used under EU law for the supply of goods? Yep, I was looking for dispatch or dispatches there. Acquisition is a purchase of a good, dispatch is a supply. Next one, what is the place of supply for a B2B supply of goods between Northern Ireland and Germany? Well done, everyone. Everyone got that right. So yes, it would be Germany. It'd be a dispatch in the Northern Ireland and an acquisition in Germany. So what is the place of supply for a B2C supply of goods between Northern Ireland and France, where the total supplies across the EU have not exceeded the distance selling threshold? Well done, everyone. Yep, that would be Northern Ireland. What scheme can be used to avoid multiple VAT registrations for a Northern Ireland business supplying B2C goods to the EU? Yep, everyone got that right. So the one-stop shop union scheme. Okay, a Northern Ireland business purchases some crash helmets from a French supplier. Would the Northern Ireland business have to account for UK VAT on this acquisition? And if so, at what rate? Well done, everyone. Yes, it is a taxable supply. It would be zero rated though, as they are zero rated for VAT in the UK as protective headwear. When is the deadline for submitting an EC sales list return? Yep, everyone got that right. So 21 days after the period end. And somebody got a bonus point there for saying it's online, because they are usually submitted online. A UK business imports some work of art. What rate of import VAT applies? Okay, so mixture of answers there. The correct answer is the reduced rate of VAT. All right, we've got 3 more questions to go, so keep going, everyone. A UK business pays import VAT on a supply of goods when they arrive into the UK. When can the business treat this import VAT as import tax and recover through their VAT return? Okay, yeah, so a few people got this correct. It's when upon receipt of the C79, which are now received online via the customs declaration service. So that is the evidence you need in order to be able to treat the import VAT as import tax on the VAT return. Last but not No, it's not last but not least. It's the last but one. What scheme can a UK fully taxable business importing goods use in order to have a nil net effect on their VAT return? Well done, everyone. Yeah, that's right. It's postponed VAT accounting. Now it's last but not least. A UK business purchases goods from an Italian supplier, but asks for the goods to be shipped directly to a French business customer. What can the business do to take advantage of triangulation? Okay, so most people got that correct. So they can do three things really. They can either register in Italy, they can register in France, or they could register in another EU state. And if they did it in another EU state where there's no other sales or purchases, then that would have a nil net VAT effect. Okay, so well done, everyone. That comes to the conclusion of the quiz and the presentation.
Yeah, thank you for that presentation, Paula. I think it just demonstrates that the implications of VAT, especially post-Brexit, relation to imports and exports, is a bit of a minefield and a bit complicated. So, as I say, this session's been recorded. The slides will be available on the websites for both chambers. But if anything does come up that's outside ordinary business trading, please feel free to reach out to myself or Paula. And we're more than happy to help with those kind of situations. So thank you very much for joining, and hope to see you again soon. Thank you.